Hi, good afternoon, and welcome to today's webinar, the 990PF, How to Reap Savings and to Avoid Pitfalls. I'm Jeffrey Haskell, and I'm the Chief Legal Officer at Foundation Source. I want to thank you for taking the time out of your busy day to attend today's webinar. Just a few housekeeping items before we begin. If you have any questions, feel free to enter them in the Q&A. We don't get your question by the end of the webinar. If we don't get to it, we'll follow up with you afterwards. After the webinar, you'll receive a link to the recording of the session. And for anyone not familiar with our firm, Foundation Source is the nation's largest provider of management solutions for private foundations. We provide the services that are required to keep foundations running smoothly and compliantly on a day-to-day basis, and we take care of the behind-the-scenes administrative work while you focus on your philanthropy. And this presentation, just note, is not intended to be construed as tax, legal, or investment advice. We empower people and companies to create a better world with their philanthropy through our suite of services, including administrative support, active compliance monitoring, tax and legal expertise, online foundation management tools, and philanthropic advisory services. For example, we provide compliance at the point of transaction for all transactions that are processed through our system. Plus, we have a staff of compliance experts available to answer any questions about anticipated foundation transactions or activities. We also track all transactions and asset information and can handle tax return preparation and state filings as well. As we celebrate over 2 decades of service, Foundation Source is proud to support more than 2,000 private foundation clients of all sizes and across the nation who have together granted more than $10 billion to charity. Well, our technology platform called Impactfully is quite unique as well, I should mention. And that it provides access to all information that a client would need about their foundation at the click of a button, from grant history to key foundation documents to online tracking of all 5% payout requirements. And of course, I would be remiss not to mention that each foundation has a private client advisor that they can contact directly with any questions or concerns. Whether a foundation is big or small, brand new, or in existence for many years, or you need us to provide one, Foundation Source has the technology and the expertise to make giving easy and worry-free. Now let's get to the technical stuff. So what you see over here is a sneak preview of what we're going to cover today. Today we'll focus on the 990PF, which I always say is kind of its own animal. It's called an information return, but it's not just an information return. It's also used to report violations like self-dealing and taxable expenditures, for example. And while it's not an income tax return per se, because you're not paying income tax, foundations, after all, are exempt from income tax. An important component of the return is the calculation of net investment income and reporting the foundation's related excise tax liability. So in short, Form 990PF is a complex form that tries to cover a whole lot of ground, and the instructions don't make preparation any easier, as they can often be unclear and helpful, and sometimes just downright confusing. Now, with few exceptions, there aren't many return preparers that prepare more than just a handful of 990PFs in any given year, limiting the opportunity to gain practical experience in preparing this form. And if you're a return preparer and you're listening in, your clients will be turning to you for help in deciphering this form and understanding how the foundation compliance rules are folded into the return. But whether you're a return preparer or not, the key data points that we'll cover today are bound to be top of mind for you. We'll be talking about the foundation's tax liability, whether the foundation satisfied its minimum payout requirement, how to calculate next year's minimum payout requirement, and reporting violations of foundation compliance rules. Now on to the 990PF. So As we track the key data points I mentioned earlier, we'll cover the most common pitfalls that we see on the 990PF so that you'll feel confident about being able to avoid them. Even though we'll be bouncing back and forth between different sections on the return, we'll be approaching this in a logical order, and we'll have covered all the key points of the return by the time that we're done. So as we go through the 990PF, please bear in mind that the screenshots that you're about to see are of a 2022 annual return for a private foundation that's on a calendar year. Although foundations are exempt from income tax, as I mentioned a moment ago, they do pay an excise tax on net investment income. The excise tax rate is a flat 1.39%. Now, up until just a few years ago, it was a default rate of 2%, although the foundation had the opportunity to qualify for a reduced 1% tax rate in a given year if the foundation met certain special distribution requirements separate and apart from the annual 5% requirement. Fortunately, however, the IRS has decided to simplify things and apply a 1.39% tax rate across the board. Net investment income is the foundation's gross investment income, which includes interest, dividends, rent, plus net capital gains, less investment expenses. Note that long-term and short-term capital gains are taxed at the same flat 1.39% tax rate, and the excise tax on capital gains will apply regardless of whether an asset is an investment or a charitable asset. Back in the old days, many years ago, the tax didn't apply to charitable use asset. Now it applies regardless of the character of the asset. Also remember that capital loss can be used only to offset capital gains and not other types of income. It's also important to note that unlike with individuals and businesses, net capital losses are trapped in a sense because they can't be carried over to future years. So if you end the year with capital losses, it's kind of lost forever. Another matter to consider is that private foundations, like other exempt organizations, may have, tainted income known as unrelated business taxable income, or UBTI, which is taxed at for-profit income tax rates and is reported on another federal return entirely, the Form 990T. Now, I say tainted. There's nothing wrong with having some unrelated business taxable income. We just call it tainted because it's subject to income tax, whereas the foundation's typical investment assets don't give rise to income tax. Most commonly, foundations have UBTI when they invest on margin or when they invest in partnerships and are allocated a share of flow-through income. Foundations don't pay an excise tax on income that's classified as UBTI. So in other words, you're not going to be paying both an excise tax and an income tax. It's really binary. It's going to be one or the other. Okay, so what you're looking at here is an excerpt from the first page of the return, the 990PF, and every column on this page has a specific purpose. So the first column you'll see is entitled Revenue and Expenses per Books. It's a straightforward financial report of money coming in and going out. However, this column doesn't assign any particular character to the revenue or expenses. The purpose of the second column, the one that's highlighted here, is to determine the foundation's net investment income, which again will be subject to the flat excise tax rate of 1.39%. Now, the top half of the column reports the foundation's gross investment income and net capital gains income, while the bottom half of the column reports the foundation's investment-related expenses. Any expenses that are identified as an investment expense in this column cannot also be used to satisfy the foundation's annual minimum distribution requirement, and I'll be using the term MDR throughout. So just to be clear, dollar for dollar, if you have an expense and you're going to characterize it as an investment expense, which will have the effect of reducing your excise tax, you can't apply that same dollar towards satisfying your 5% payout requirement, and vice versa. if you have a disbursement that you're characterizing as a qualifying distribution, meaning it's going to count towards satisfying the foundation's annual 5% payout requirement, the NDR, dollar for dollar, that same dollar cannot also be an offset to your investment income. So it's really, again, binary, one or the other. Generally, the third column, you're entitled adjusted net income, is relevant really typically only to operating foundations, and only is it rarely applicable to non-operating or grant-making foundations, like we're talking about here, that directly run their own revenue-producing charitable programs. Now, finally, the fourth column, entitled Disbursements for Charitable Expenses, that identifies the foundation's qualifying distributions, which are, as I mentioned, is used to satisfy the foundation's annual MDR. And that will include grants and any operating expenses that can be counted towards satisfying MDR. The theme here of the most common pitfalls is one of leaving money on the table or paying more taxes to the IRS than necessary because the foundation didn't use investment expenses when it could have, such as investment management fees and bank charges to offset its gross income. As I mentioned earlier, a foundation can't double dip by treating the same portion of an expense as an investment expense in column B and as a qualifying distribution in column D. All too often, though, we see the same expense appearing in both columns and applied for both purposes. Also, although the foundation's excise tax liability is a type of overhead, it can't be counted as a qualifying distribution in column D. Interestingly, the excise tax payments can't be classified as an investment expense either to offset the foundation's gross investment income in column B. Finally, we often see foundations incorrectly reporting income classified as unrelated business taxable income in column B, meaning that they're subjecting the same income to both an excise tax and an income tax. Again, any UBTI and any related expenses that may offset UBI, unrelated business income, should be reflected in column A only and reported on the 990T, where you're going to actually calculate the tax liability. The tax on then, again, on the UBTI will be calculated reportedly on the 990T. It won't be calculated on the PF. Okay. Now, just a quick glance at capital gains and losses. This table in part 4 requires the foundation to distinguish between capital assets that were purchased by the foundation and those that were donated to the foundation. And when you're calculating capital gain from the sale of a donated capital asset, the foundation needs to use the donor's basis, which the foundation inherits or carries over at the time of the donation. So you need to keep careful track, not only of how the foundation came to acquire any particular lot of stock, but if it was donated, the appropriate basis that the donor had when they contributed the stock or other asset. Now, many foundations don't realize here that they need to record the donor's basis when they receive donations, as I've mentioned. That's a very common pitfall. So they need to do it, but we see that they don't. Also, many foundations don't realize that it's not necessary to attach reams of brokerage statements containing confidential account information for the world to see, because the returns are made public. They don't need to attach those to the returns. Instead, the sales of publicly traded securities are consolidated on a single line with no need for supporting details. However, sales of other types of assets, like real property or limited partnership interests, do need to be broken out individually. Okay. Here we see the foundation's tax liability in part 5, line 5. It's highlighted. And again, this would be 1.39% of the net investment income shown at the bottom of the first page of the return, the bottom of column B. Now let's turn our attention to the minimum distribution requirement, the MDR. Well, this is very important to have hash this out and right up front, because when we speak to clients, we use the term minimum distribution requirement, or MDR, to mean the minimum amount that must be distributed before the end of the foundation's current tax year to avoid a 30% under distribution penalty. And that's a term that most people can relate to because it lets them know what needs to be done in the current tax year. However, it's not like a term that's defining the Internal Revenue Code or the regs. It's one that's just commonly used by the foundations themselves because it's a foundation-centric term. Now, the IRS, on the other hand, uses a different term. They use this arcane-sounding phrase called undistributed income, or UI, which basically means the amount that must be distributed before the end of the foundation's next tax year to avoid a penalty. Now, why does the IRS do that? They do that because the foundation's payout requirement, the MDR, it relates to a foundation's payout requirement of the previous year. So in other words, a foundation's payout requirement, the amount they must distribute by the end of a given year, is based on the preceding year's asset average. So the IRS focuses on the source of the payout requirement. So since the source, the asset average from the preceding year, is what drives the current year's payout requirement, they're all focused on the prior year. Again, whereas clients are typically focused on what do I need to do this year. So for example, we would call the amount that must be distributed by the end of 2023 to avoid a penalty, we'd simply call that the 2023 MDR, as would most clients. But the IRS and the 99DPF, they don't call it that. They refer to that amount as the 2022 UI because it's derived from the foundation's 2022 investment asset averages. Moving along, second, here we go. Now we turn to one of the most common questions that we see that foundations have, which is, what was the payout requirement for the return year? And did my foundation satisfy it? And of course, they want to know because to the extent that you don't satisfy your MDR, whatever that shortfall is, it's a 30% penalty. So if a foundation has $1 million payout requirement, MDR, and they only grant out or have qualifying distributions of 900,000, creating a $100,000 shortfall, there's a 30% penalty on that shortfall. So 30% of 100,000 would translate into a $30,000 penalty for not distributing the entire million, but only 900,000 of the total amount. So how do we figure out, what the MDR was for the return year and whether or not the foundation satisfied it? So to figure it out, we need to know where to find it on the return, and this is the currency, the qualifying distribution used to satisfy MDR. So again, it's not just enough to know the target. You also need to know what the foundation's total qualifying distributions were for the year, because that's the currency, as it were, that you're using, the ammunition that you're using to satisfy that 5% MDR. Okay. So here in part 12, on line 2A, column C, it's highlighted over here. In the highlighted area, we see the foundation's 2022 MDR, the return year MDR. Again, this is the 2022 tax return that we're looking at, and we want to know what did the foundation have to distribute in 2022. And so the 2021 UI, this amount here, that really represented the amount it had to grant out in 2022 to avoid a penalty. And here you can see the amount is about $270,000. And again, if the foundation didn't distribute at least that amount in qualifying distributions in 2022, the foundation would owe a 30% penalty on any shortfall. Qualifying distributions, what are they made up of? They are composed of grants and qualifying expenses, which appear on the first page of the return, part 1, column D. However, there are other types of qualifying distributions that count towards satisfaction of the MDR. Those include amounts spent to acquire charitable assets, which are those that are used directly to advance a charitable foundation purpose, amounts that are set aside pursuant to special rules for future grants or projects, and investments that are known as program-related investments, or PRIs, which are investments that are made to achieve a social return rather than a financial return, and that meet certain technical requirements set forth in the code and the regulations. So now let's briefly revisit part one and note, at the bottom of part one, column D reports the sum of all grants and qualifying expenses made during the return year. And here the total is about $270,800. Note that the column must be prepared using the cash method of accounting, even if the foundation is otherwise on the accrual method of accounting. This means that grants, which are merely pledged to be paid in a future year, cannot be counted toward satisfying the return year's MDR. The most common mistakes here that we encounter include counting expenses that are accrued but not yet paid towards satisfying the MDR, counting certain prohibited expenses, like those related to lobbying and electioneering, as qualifying distributions, causing the foundation to make more grants than is necessary because qualifying expenses were not reported in column D as qualifying distributions, though they should have been, and failing to bifurcate an expense when one portion of it is a qualifying distribution and the balance is an investment expense. For example, suppose that the foundation receives an invoice from a law firm charging $10,000. 3,000, let's say, of the 10,000 was for negotiating a subscription agreement, and 7,000, let's say, was for updating the foundation's bylaws. In that case, $3,000 of the expense should be allocated to column B as an investment expense, and 7,000 should be allocated to column D as a qualifying distribution. So in sum, the entire $10,000 legal expense would be reported in column A, 3,000 will be reported in column B as an investment expense, and 7,000 will be reported as a qualifying distribution in column D. One last notable mistake we see is the completion of portions of the return that should be left blank because they just don't apply to non-operating grant-making foundations of the sort we're talking about today. Here in part 11, line 4, we see all of the different parts, different types of qualifying distributions that are consolidated and summed up. We see total grants and qualifying expenses, and it tells you where it's coming from, part 1, column D, the lower right-hand part of the page of page 1. Then we see amounts invested in program-related investments, or PRIs, amounts paid to acquire charitable assets, and amounts that are set aside for a specific charitable project. If we look here, the total qualifying distributions for 2022, the return year, is about $270,800, slightly rounded up. Now, as we saw earlier, the 2022 MDR is a little over $270,000, as reflected in Part 12, line 2A, at the top of column C. That's over here. The total 2022 qualifying distributions of about $270,800, which is over here, okay, that we just tallied up on the prior page on part 11, are carried over here to part 12, line 4, and will be used to satisfy the foundation's MDR of 270,212. First, what we're going to do is that we're going to apply the portion of these 2022 MDR to satisfy the requirement. So here we're taking out 270,800 and we're peeling away 270,212 to satisfy in full the foundation's 2022 MDR. Okay. Had there been a shortfall, the foundation would have made less than the required amount. It would have been reported over here in line 6E, column E. Sorry about that. Over here in this box over here, any shortfall. And that would have been subject to the 30% penalty. So seeing anything in that box, that cell is bad news. Okay. Now we'll turn our attention to another major data point on the return, the foundation's MDR for the following year, in this case, 2023. So as discussed, next year's MDR is based on the return year's investment asset average, right? However, the regulations exclude the value of any charitable assets that the foundation may own and provide specific rules determining the average values of cash and publicly traded securities, real estate, and other non-cash assets. Okay. First, we're going to calculate next year's MDR, and we're going to do so by figuring out the foundation's minimum investment return here, which we're going to call MIR in part 9. Generally, what the MIR is, just to demystify this, is the return year's asset average with minor adjustments and multiplied by 5%. That's generally what it is. And this results here in a 2022 minimum investment return, or MIR, of about $251,000, as shown on line 6, right over here. Note that the foundation's asset average is a bit of a black box, and that there are no worksheets or calculations for computing it that are attached to the return. We see only the end product of those calculations, which makes it difficult or impossible to spot errors in the calculations. Now, if this had been a short tax year, such as the initial year, the usual MIR percentage, here 5%, would have been prorated by the fraction created by dividing the number of days in the year by 365. For example, a calendar year foundation formed on July 1 would apply an MIR percentage of only 2.5% in its initial tax year, because 5% times the fraction of 182 over 365 is 2.5%. That makes sense, because since the foundation existed for only half of its initial year, it would make sense that its MDR, which is again based on that year, that partial year, would be only half of the usual 5%. It kind of actually does make sense. So while the balance sheet shows a snapshot of the value of the foundation's assets on the last day of the year, MIR is calculated by determining the average value of investment assets over the year, which is fair, and you can understand where that's coming from, because if you have assets that appreciated incredibly in value, towards the very end of the year, your payout requirement for the following year is going to be huge. And it can be the other way around. If there was like a market crash and they sank at the end of the year, you can have an artificially low payout requirement. So the idea of averaging creates a fairer and smoother idea of what your payout requirement for the following year should really be. You'll notice that charitable assets, again, are excluded from the asset average. I mentioned that. And that's why the balance sheet here in the highlighted area reports charitable and investment assets on different lines. So think of it this way. I know you may be thinking, well, look, if the foundation has stocks and bonds that produce income, aren't those ultimately charitable assets, because I'm using the income from those investments to fund the foundation's charitable programs and grant making? So that's true, but they mean how are you directly using it? So to the extent that you're just collecting passive type income, or you're holding it for appreciation and value, that's really going to be an investment asset. On the other hand, let's say that you own property that you're using directly for charitable purpose. So let's say, for example, you own an apartment building and you allow startup public charities, to rent space for no or very low rent. And you're using it for clearly for a charitable purpose or for some other charitable program. In that case, the building is not going to be producing revenue. And that's key, because if you have an asset and you're dedicating it to a charitable use that may not be producing any income, it would be a big drain on the foundation if the foundation's 5% payout requirement took into account the value of that asset. So I have $1 million building and I'm using it for after school programs for kids that I'm running on my own. So I'm not collecting any rent. If I wasn't able to exclude the value of that building from the foundation's 5% calculations, that $1 million building would give rise roughly to a $50,000 per year payout. But by having this special classification as a charitable asset, it's carved out and doesn't create any drag on my liquidity. Okay, moving along. Okay, some of the most common errors that we see here include including charitable assets in the average asset base used to determine the MDR. Another one is reporting investment assets on the lines of the balance sheet that's really meant only for reporting charitable assets. But that's because very often people don't understand the difference between these different asset types. Another one would be incorrectly inflating next year's MDR because the usual 5% MIR percentage wasn't properly prorated in the initial tax year. You see that all the time. Also using end of year fair market values on the balance sheet to calculate the foundation's asset average instead of applying the special rules that are in the regulations for calculating asset averages. Additionally, although you can't tell by looking at the 990 PF, because again, you don't see the worksheets behind it, I strongly suspect that many foundations aren't prorating the value of an alternative asset like real estate or private equity interest based on the number of days the foundation held the asset. So for example, if I bought a ranch midway through the year for $1 million, it's not quite fair to treat that ranch, the $1 million value of the ranch, and count 5% of that towards my next year's payout requirement because I only owned it for half a year. The effect of prorating the value. So if I held it for exactly half of the full tax year, and the value of the ranch is normally $1 million, for this one time, calculating its impact on the 5% payout requirement for the next year, I'd have the value from $1 million to $500,000, which will mitigate the impact on next year's MDR to reflect the fact that I only had it for half a year. Okay. So the next thing we need to do is calculate the distributable amount. So we're going to use the return year's minimum investment return, the MIR, as a springboard, as it were, for calculating next year's tentative or raw MDR, known as the distributable amount, DA. In this step, we take the return year's minimum investment return, we back out that year's tax liability, and finally make some further adjustments for any recoveries, which we'll talk about in 1 second. And the resulting number is going to be the distributable amount, representing, think of it as the tentative MDR for the next year, for 2023. So what is a recovery? A recovery occurs when a grant or a qualifying expense paid in 1 year is returned to the foundation in another year, creating a makeup distribution requirement. So recovery in 1 year will result in a dollar for dollar increase in the following year's MDR. So when might that happen? So let's say you make a grant towards the end of the year in December for a particular program that's being run by a charity. You send them a check, you count it towards meeting your 5% payout requirement, and then maybe sometime in January or February, unexpectedly, the charity mails you back the check and says, thank you, but no thanks. We canceled the program for whatever reasons. What do you do? Well, that's a recovery. Okay. Okay, so we're going to talk about what I call the flow here. First, how does this all work? Calculating next year's payout requirement. So the exercise of this page and what we're going to talk about for the next minute or two is to figure out what is next year's payout requirement. So spoiler alert, we're going to end up here. Whatever is in this cell, that is actually going to be the next year's payout requirement, okay? But how do we get there? How does it all work? So the first thing that we do is we start with the qualifying distributions for the return year. That's over here. These are the 2022 qualifying distributions. And what do? First thing we do is that we pay off the return year's MDR, which we said earlier was 270,212. So first, bam, we're peeling off 270,212 to fully satisfy, to offset in full the 2022 payout requirement. Okay. Second, if the foundation made more qualifying distributions than was strictly necessary, which it did, right? It only had to give out 272.12, but it gave out 277.87. So there's a few hundred dollars excess, 575. So if you give away more than you absolutely strictly needed to, that amount, that excess, is applied towards satisfying next year's tentative MDR. So that's why we call this amount, the DA, the raw or tentative payout requirement, because to the extent that you granted out more than you needed to in the return year, this tentative amount is going to be reduced. And in fact, it is from 249,756 to 249,181. Okay, so if you have even more qualifying distributions left over than you needed to satisfy both the 2022 MDR and next year's MDR, then any excess is going to be banked as excess grants carryover, where it can be carried over for up to 5 years to offset a future year's MDR. So here, this is about 250. This is, let's say the foundation had granted out in 2022 and qualify $1 million. So it would have had enough to satisfy the 2022 MDR, would have had enough to fully satisfy and fully offset the 2023 MDR, and the excess would go down here, would be banked as an excess grant carryover, where it could be used to offset the foundation's payout requirements for the next 5 years. Now, the only thing to keep in mind is that in future years, after applying any extra qualifying distributions, only then you get the opportunity to offset your payout requirement with these banked excess grants. So the point is that you can only use these bank grants in the proper sequence. That is, they can be used only after the return year's extra qualifying distributions have been applied towards next year's MDR. So why am I making a fuss about that? You'll see in 1 second as a common pitfall. In many cases, the entire grid that we saw on the prior screen is left blank. This one here, I've seen it like this is completely blank and there's nothing there. Now it's important to note that if a foundation under distributes in 1 year and makes up the shortfall in a later year by making more grants, the shortfall is not automatically corrected as a technical matter. Part 12 has to reflect the special election that must be made, and a signed election must be attached to the return. I go there for 1 second. You'll see there's talking about election required here. There are various elections that you do, and these are involved with correcting prior year shortfalls. It doesn't happen automatically. It has to be signed and it has to be attached to the return. Now, even when Part 12 is completed properly to reflect the election, more often than not, the special election isn't attached to the return, or when it's attached, it's not signed. And finally, another very common mistake is using banked excess grant carryovers to reduce next year's payout requirement before taking into account the return year's extra qualifying distributions. Okay, I promise I'd explain why this matters, so here's why. This mistake, this error, has the effect of constantly refreshing the excess grant carryover so that they never expire, which sounds great, but it's incorrect and is in conflict with the regs, because per the regs and the code, the excess grant carryover is supposed to expire after 5 years if you're not using it. They can't be artificially refreshed. Okay. Now let's take a look at how the IRS inquires about possible violations on the 990PF, which is Part 6B. So I finally call this section of the return the rat yourself out section. It's used to report potential and actual violations of the foundation rules that you see here. If a foundation violates one of these rules, the foundation's return must reflect the violation, which triggers the need to file a federal penalty return, Form 4720. You'll see here that the IRS asks whether the foundation engaged in any of a number of transactions or other activities that might constitute self-dealing. Then they ask whether any of them fail to qualify for an exception to the rules. The wording is a bit awkward and oddly the response that signals compliance with the rules is no, meaning that no, none of the acts fail to qualify for an exception. In the event that a foundation must answer yes to that question, indicating that one or more of the acts fail to qualify for an exception under the rules, the IRS would expect the foundation to file again a penalty return, the 4720, which requires the foundation to provide all the details of the violation and to calculate the penalty due, which must be paid by the involved foundation insider rather than by the foundation. So let me just say it again because it's so weird that you have the foundation filing a return calculating another taxpayer's penalty because the foundation never pays the self-dealing penalties. The insider who violated the rules pays them. So the foundation has an obligation to file this penalty return, as does the insider who actually violated these rules. So the foundation attempts to, if the foundation in fact were to try to cover the penalty payment, that in itself would result in another act of self-dealing and more penalties on the insider. So in this section, it's not good enough, by the way, that you tell the IRS about any self-dealing violations that may have occurred during the return year. The form also requires the foundation to disclose any self-dealing violation that occurred in a prior year that was not corrected before the first day of the return year. So anything that's out there that's uncorrected, you have to report it. And that's because if a self-dealing violation isn't corrected, the penalty is reassessed each year until correction has been accomplished. And in some cases, the failure to correct can be treated as a new violation in each subsequent year, like a stacking or a pyramiding of penalties. Pretty intense. Okay, now similar to self-dealing now, we're going to move on to the payout requirement and under distribution. The foundation is actually required to disclose past year MD or shortfall violations that were not corrected by the end of the prior year. And that's because, again, the penalty is reassessed for each year that you miss that penalty, and it goes by uncorrected. As you might imagine, the penalties can stack and pyramid very quickly if the foundation leaves this unattended to for a number of years, even just a few years. Okay. Next up is a question regarding excess business holding violations. These rules generally limit the ownership stake that a foundation and its insiders collectively may have in an active business. Line 3A reflects the de minimis rule, which permits the foundation to ignore the holdings of its insiders so long as the foundation itself doesn't own, directly or indirectly, more than 2% of the vote and value of a business enterprise. So what is that? A business enterprise is an entity that has more than 5% of its gross income derived from the active conduct of a business, providing services, or from the sale of goods. So again, active income sources. Note, however, that there's no ownership limitation on a foundation's interest in a passive investment vehicle. That is, an entity that has 95% or more of its gross income derived from passive sources, such as interest, dividends, rents, royalties, and capital gains. That's why the yes checkbox here shouldn't be checked if a foundation owns more than 2% of a mere passive investment vehicle. Now, while we can't dive into the details of these rules here because they're quite nuanced, I do want to point out that there is a look-through aspect to these rules, meaning that where a foundation has an ownership interest in a passive investment vehicle, and that entity has an ownership in an underlying active business, the foundation will be deemed to hold a proportionate percentage interest in that underlying business as well. So, for example, if I own 100% of a passive investment vehicle, that's not a problem. But if that passive investment vehicle downstream owns, like, say, 80% of an active business, foundation is deemed to own 100% of 80%, and you haven't solved the problem by interposing a passive investment vehicle between the foundation and the actual active business. So just putting that out there. Okay. Here we have the section of the return asking whether the foundation made any jeopardizing investments. Now, think of a jeopardizing investment as an investment that was made without exercising ordinary business care or prudence to the extent that it's so severe that the continued existence of the foundation is itself put into jeopardy as a result of having made the investment. Now, bear investment that the jeopardizing investment rules don't apply to assets that were donated to the foundation, only those that are purchased by it. And the jeopardizing rules, the investment rules, also don't apply to program-related investments, which are, again, investments made to further a charitable return rather than a financial one. Okay. This section on taxable expenditures is focused on disbursements that are either flatly prohibited in all cases, or are made without following special procedures, or in certain cases are made without obtaining the IRS's advance approval. That roughly consolidates and roughly captures the idea of a taxable expenditure. Those are the possibilities. If a foundation makes a taxable expenditure, the foundation will be subject to a 20% penalty on the amount of the expenditure. For example, a foundation is always prohibited from making disbursements for lobbying, electioneering, or any non-charitable purpose. On the other hand, certain kinds of grants to individuals, such as scholarship grants, are permitted only if the IRS approves the foundation scholarship program in advance. Note that line 5A3 is not asking generally whether the foundation made grants to individuals at all. Instead, it's asking specifically about grants made for travel, study, or other similar purposes. If the foundation made grants to individuals for another purpose, such as to provide hardship assistance or emergency assistance, advance IRS approval wouldn't be required. In that case, the foundation would just answer no. Line 5C over here, we'll see, over here, asks specifically about expenditure responsibility grants, which are grants that require special oversight because they are made to organizations that aren't recognized by the IRS as public charities. If the foundation reports on line 5A4 that it made grants to a non-public charity, it must indicate on line 5C whether it properly exercised expenditure responsibility in doing so. If it didn't, the grant will be subject to a penalty. Note that a grant to another foundation requires expenditure responsibility, even though the other foundation, the grantee, is itself a 501c3. Why? Because even though another foundation would be a 501c3, it's not a public charity. So lastly, many foundations don't realize that in any given year, the foundation will need to attach an expenditure responsibility attachment to the return if, one, the foundation made an expenditure responsibility grant during the year, two, some of the grant funds remain unspent at the end of the return year, and three is the tricky one because many people don't realize this. If the foundation received an expenditure responsibility report from the grantee during the year, and that's true even if the grant funds were fully spent down in the prior year. In passing, I'll just note here that the return doesn't ask whether the foundation made any uncorrected taxable expenditures in past years, which is different from what we saw with respect to self-dealing and the minimum payout requirement shortfalls. So let's take a look at some common pitfalls when it comes to reporting taxable expenditures. So although a scholarship grant to an individual is in fact considered a grant for travel, study, or other similar purposes, a grant made in support of a university scholarship fund, where the university, not the foundation, chooses the scholarship recipients, is not considered a grant made to an individual at all. It's considered made to the university. Rather, again, it would be considered made to the university, and therefore you would answer no. Bear in mind also that the expenditure responsibility rules are very unforgiving. Failing to observe even one small part of the procedures as outlined in the regulations for example, by failing to attach a necessary statement on the return, can result in a violation as though expenditure responsibility had not been exercised at all. And while filing an amended return can, in fact, remedy some oversights under 990PF, the IRS does not consider a return amendment sufficient for purposes of correcting a mistake in following the expenditure responsibility rules. Finally, we'll take a quick look at Part 6A of the 990PF, which discloses information about the foundation's operations and activities. If a foundation has made any changes to its formation documents, bylaws, or similar instruments that haven't been previously reported to the IRS, the foundation must report those changes here and include a conformed copy of the amended document to the return. Line 4A asks whether the foundation has unrelated business gross income of $1,000 or more during the year. If so, the foundation has to answer yes, even if the foundation had an unrelated business net loss for the year. If the answer to this question is yes, the IRS is going to expect the foundation to file Form 990T to report such unrelated business income. On line 8A, per the instructions, the foundation must list all states to which it reports in any way about its organization, assets, or activities, as well as all states in which the foundation has registered as a charitable organization or indicated that it holds property there for a charitable purpose. And finally, line 10, highlighted, asks whether any persons became substantial contributors during the return year. In order to accurately respond to line 10, the foundation needs to keep close track of its donors on an ongoing basis using the appropriate formula that's used to calculate whether a donor has become a substantial contributor over the course of the year. And we see some common pitfalls over here. What are they? So in addition to the pitfalls listed here, another common pitfall that we routinely encounter is a failure to indicate on the return any state at all in which the foundation is registered or to which it reports. So certainly, if it's incorporated, should it at the very least be its state of incorporation, for example. Certainly, at least one state is expected to be listed, not a total blank. And yet another pitfall is to report donors as substantial contributors in multiple years on multiple returns. See, the return only asks for a listing of donors who became a substantial contributor for the first time that year, not over and over again. And that brings us to the end of our presentation. I believe there might be some questions here. Let's see, I have one question here regarding asset classification. What if the foundation has an asset that is used partly for investment use and partly for charitable use? How would you classify it? So that's an interesting question. So I guess it would depend on the nature of the property. For example, when it comes to a building, you would often use square footage. So let's say I had an office building and it has 100,000 square feet in it, and approximately 75,000 square feet I have rented out for a fair value rent to various commercial tenants, and 25% I let various charities use for free because it's like an incubation, or again, I'm running my own program out of there, providing maybe after school enrichment to grade school kids or whatever that might be. In that case, I would go with a split based on the square footage that would seem to be reasonable. You probably also want to document this at the foundation level with some sort of minutes or policy regarding how the foundation has decided to go about allocating or splitting up the use of the asset. So here's another question. It says, you mentioned that a recovery, such as a return grant or charitable expense, must be taken into account when calculating MDR. Can you provide some practical examples when or why the foundation might have a recovery? Well, I think I gave an example of that already when I was speaking. I'd say that what I've seen most typically is when a foundation makes a grant, not for a general and unrestricted purpose, but like it's for a specific purpose. It's a restricted grant and it's intended to subsidize a particular program that the charity might be running. And so you send the check, and so it comes back because they say, sorry, either we're terminating totally, or because it may be that we're terminating this program. It's not feasible to run anymore, or for whatever other reason. Those are typical reasons why I would see. And then the check comes back, and you're like, what do I do now? Do I have to amend my return where I reported this originally? What happens? So the classic example would be foundation had a $100,000 payout requirement. Let's say the foundation satisfied that requirement in full with one check to one charity for a particular program, and the program is canceled and you get the check back after the tax year is over. What happens? Is there a penalty? So again, there's no penalty, and there's no need to amend the return where you claim that $100,000 grant as a qualifying distribution because you did so in good faith. Instead, what will happen is that on the next year's return, the year in which the money came back, you would report that $100,000 as a recovery. And so when calculating the following year's payout requirement, it would be increased dollar for dollar by the amount that was returned. I mean, it's only fair because you counted the money you granted out in year one initially towards meeting your 5%, but you got it all back. So it makes sense you'd have a makeup requirement of sorts and would have to reapply that at some point in the future. But at least it's reasonable in that it doesn't require an amendment to a return, and it doesn't impose penalties. And I think those are all the questions that we have for today. Well, thank you for joining us here today. As I mentioned earlier, you'll receive a link to recording of this session, and we'll be following up with any Q&As that we received that we didn't get to this afternoon. Again, have a pleasant afternoon and pleasure spending time with you today.